This is a video about principles of option contract. First, we talk about definition and concept of option contract. So option, by simple definition, is a contract to buy and sell a specified asset at a specified price and time. Like futures contract, the price is agreed today, but the fulfillment of the contract will be executed later. However, option contract does not oblige both parties to fulfill the contract. As the name implies, one party in option contract will be given an option either to execute or not execute his option contract. So this table shows the difference between futures and option. For futures and forward contract, if you buy contract, you get obligation to exercise the contract, and seller of a contract also get obligation to exercise the contract. That's mean for futures contract, at the maturity date of the futures contract, both party, which are the buyer and seller of contract, need to exercise the contract. For option contract, if you buy option contract, you get right to exercise, where if you sell your option contract, you get obligation to exercise your option contract. So obligation of seller of option contract is based on the decision of buyer of contract. Let's say buyer of option contract decide to exercise the contract, then seller of option contract must exercise the contract. If the buyer of contract decide to let go the contract, then seller of contract don't need to exercise the option contract. We have two types of option contract in the market. The first one, we call it as a call option contract. The second one is put option contract. So, as I mentioned before, option contract is a contract where buyer of the contract get right to exercise and seller of option contract get obligation to exercise the contract. So now we look in terms of call option. So what is call option? Call option is an option contract where buyer of call option contract get right to buy underlying asset, whereas seller of call option contract get obligation to sell the underlying asset. Okay, for put option contract is a contract where the buyer of put option contract get right to sell the underlying asset, and seller of put option contract get obligation to buy the underlying asset. And then we have premium for option contract. So both option contract, call option and put option, they have price in the market. So the price of option, sometimes we call it as a premium of option. If you buy option contract, okay, call option or put option, you need to pay premium. So premium is considered as a cash outflow or expenses for the buyer of contract. Whereas for the seller of option contract, premium is considered as a cash inflow or income, because when you sell option contract, you will receive the premium. Now we look at example how the operation of call option contract in the market. Let's say we have one OKLI December 1660 call at 18 ringgit. So this OKLI December 1660 call at 18 ringgit means the exercise price for the contract is 1660, the premium is 18. So let's say now we have a buyer and a seller of this call option contract. So today, buyer of call option contract, he buy call OKLI December with exercise price of 1660 from the seller of call option. Therefore, he needs to pay 18 ringgit as a premium to the seller. So seller need to sell that call OKLI December with exercise price 1660. So he receive 18 as a premium. So 18 premium here for buyer of call option is a cost of expenses. 18 of the premium is considered as an income or revenue for the seller of call option contract. So when buyer of call option contract pay the premium to the seller and buy the call option contract, so buyer of call option contract, he get right to buy shares at price 1660, which is the exercise price of the option contract. Okay, so this contract is going to expire in December because the name is OKLI December. Okay, so seller of call option contract, when he sell call option contract, he get obligation to sell the shares at price 1660. So this is the transaction today. So buyer buy call option, so he need to pay premium. Seller, he sell call option contract, so he receive the call option premium. Okay, so buyer get right to buy shares, seller get obligation to sell shares. So let's say the buyer hold that option contract, and later on at the maturity date of the option contract, let's say in December, buyer of call option decide to exercise his call option contract. So at that time, seller of call option, he must exercise the call option contract based on the buyer of call option's decision. Because buyer decide to exercise, so seller must follow to exercise the call option contract. So when they exercise the call option contract, that means buyer of call option contract, he buy shares at price 1660. So that means at the maturity date of call option contract, buyer can buy share at price of exercise price of call option contract, which is 1660. Seller of call option contract, when the buyer of call option decide to exercise the contract, he need to sell the shares at price 1660. So this is the operation of call option contract. Next, we have example for put option. Let's say now we have in the market OKLI December 1700 put at 20. That means 1700 is the exercise price and the 20 is the premium. So today, if I decide to buy the option contract, the put option contract, so I'm the buyer of put option contract, and you sell this put option contract, so you become the seller of option contract. So when I buy this put option contract, so I need to pay you as a seller the premium. So in this example, the premium is 20 ringgit for the premium. So I need to pay 20 ringgit to you, and you receive that 20 ringgit as your income. So that 20 ringgit is considered as cost or expenses, and that 20 ringgit of premium is considered as your income or revenue from selling that option contract, put option contract. So when I buy put option contract, today I get right to sell the shares at the price 1700, which is the exercise price of put option contract. You, as a seller of option contract, you get obligation to buy the shares at price 1700. So let's say I hold that option contract, put option contract until maturity date. So later on the maturity date, I as a buyer of put option contract, I decide to exercise the put option contract. So you as a seller of put option contract, you must exercise that put option contract based on my decision. Because I'm the buyer, I have right to exercise. You as a seller of put option contract, you get obligation to exercise. So if I exercise the put option contract, I need to sell the share at price 1700, or I can sell share at price 1700, which is the exercise price of put option contract. As a seller of put option contract, if the buyer decide to exercise the contract, you must exercise that put option contract. So in this case, you must buy shares at price 1700. Now we look at the features of option contract. First, we look in terms of underlying asset. So what is underlying asset? This is the type of asset that underlies the option contract. In the case of KLCI options, KLCI options are the derivative instruments or contract, while the underlying asset or instrument will be the FBM KLCI. Second is the exercise price. Exercise price or strike price is the price that the buyer or holder has the right to sell or buy the underlying assets from the seller of option contract. The term strike is used to indicate that the holder will exercise his right whenever his option strikes the price. Next, we look at current market price. What is current market price? This is the price of the underlying asset that is displayed in the cash market. Like futures contract, the price of option is derived from the actual price of its underlying asset. For instance, the price of option KLCI contract are dependent on actual current price of the FBM KLCI. The next term you need to understand is a premium. Premium is the price of option and is determined by the bid and ask price in the market. In other words, the premium may go up or down or remain unchanged throughout the life of option contracts. As mentioned earlier, an investor who buys an option pays premium while a seller receives it. Therefore, like stock price of index, premiums of option will fluctuate over time. Now we look at this example to understand what is the strike price, what is the current market price, and what is the option premium. Let's say we have call option for OKLI December 1660 call at 18. So that means this option contract is going to expire in December because the name of the contract is OKLI December 1660 is the exercise price of this option contract, and the call option is sell at 18 ringgit. So 18 is the premium. So to understand how the operation of call option contract, let's say today in November, you have two types of investor. The first one is investor with call option contract, or we call it as a buyer of call option. Means this investor, he buy call option contract. The second types of investor is investor without call option contract. So let's say today in November, both investor with option and investor without option, he planned to buy share in December. So investor with call option contract, he planned to buy share in December. So because of his trading objective, he buy OKLI December 1660 call at price 18. So today in November, he need to pay RM 18 ringgit as a premium to the seller of call option, and he get a right to buy share in December at price 1660. So that is investor with call option contract. Investor without call option contract, he just plan to buy share in December and do nothing. When it comes to December, both investors decide to buy share. So investor with call option contract, when it comes to December, now he has two price to buy the share. He can buy share at the current market price in December, which is 1,800, or he can buy shares using his call option contract. So he can buy share at lower price, which is at the price 1660, or at the exercise price of his call option. So that means if you have call option contract, at the maturity date of the call option contract, you can buy share at the price of market price, or you can buy shares by using your call option, which is in this example, you can buy at price 1660. If you don't have any call option, that means you are investor without call option contract. When it comes to December, you plan to buy shares, you don't have any alternative, you need to buy share at the market price in December, which is 1,800. Okay, so the difference between investor with call option contract and investor without call option contract is that at the maturity date, Investor with call option contract has two alternatives to buy the share. He can buy at market price or he can buy using his call option contract. Now we look at example for put option contract. So how the operation of put option affect transaction in the stock market. Let's say you have put option OKLI September 1900 put at 21. That means this contract is going to expire in September. The exercise price is 1900 and this is put option contract and the premium is 21. So we have two types of investor with put option contract or buyer of put option contract or investor without put option contract. Okay, so today in July, both investor plan to sell share in September. So investor A, which is investor with put option contract, he buy OKLI September 1900 put at 21. That means today he need to pay 21 premium to the seller of put option and he get right to sell shares in September at exercise price which is 1900. The second type of investor is investor without put option contract. So today in July, he just plan to sell shares in September. He does not involve in option market. When it comes to the expiry month of the September, investor with put option contract, he want to sell his share. So let's say in September, the market price of share is 1,600. So now investor with put option contract has two alternative or has two choice to sell his share. He can sell at the current market price, which is at price 1,600, or he can sell the shares by exercising his put option contract. So basically, he can sell at a higher price, which is the exercise price of put option contract 1,900. So if you have put option, you have two price to sell your shares. You can sell at the market price or you can sell at the exercise price. Investor without put option contract, he can only sell his share at the current market price in September, which is at 1,600. Next, we look at the expiration date. What is the expiration date? This is also known as the maturity date. It is the last day in which the option can be exercised. Since the emphasis is on the holder as the buyer of option, if he does not exercise until maturity date, the option will become worthless. In other words, his right to exercise lapses beyond the expiry dates of the option contract. Next, we look in terms of time to exercise. Although a buyer has the right to exercise, the time when he can exercise depends on the style of option. American style option give the holder rights to exercise on or before the expiry date. European style options only allows the holder to exercise at the expiration date. So KLCI options are European type and therefore must be settled by cash at the maturity similar to the KLCI futures. On the other hand, stock option to be introduced by Bursa Malaysia will be an American type of option. Next, we discuss about the value of option contract. The first one, value of option in the money. In the money is the option which gives the holder profit if he exercises his option contract. So, option holder will only exercise his option contract if it is in the money condition. Call option is in the money when the current market price of the underlying asset is higher than the exercise price of the option contract. So, the formula for call in the money is when the market price is higher than exercise price. For put option contract is in the money when the current market price of the underlying asset is lower than the exercise price of the option contract. So, put in the money is equal to market price less than exercise price. The second type value of option is out of the money. Out of the money is the option which gives the holder loss if he exercises his option contract. Option holder will not exercise his option contract if it is out of the money condition. So for call option is out of the money when the current market price of the aligning asset is lower than the exercise price of the option. So call out of the money when market price less than exercise price. For put option, it is out of the money when the current market price of the underlying asset is higher than the exercise price of the option. So put out of the money when market price higher than exercise price. The third value of option is at the money. At the money means the holder of option contract has neither loss nor gain to exercise either his call option or put option. So at the money call and put option is equal to market price equal to exercise price. Okay, now we look at example for call option. How call option can be out of the money, at the money, or in the money. Let's say we have one call option. The call option is OKLI September 1600 call 818. That means this is a call option going to expire in September. So 1600 is the exercise price of call option, 18 is the premium. Okay, if you look at this diagram, we have a market price of share. So in this example, let's say we have 3 market price of share. Let's say today the price is at 1,400. So 1,400 for the call option with exercise price 1,600 is considered as out of the money. Why out of the money? Because market price of share is less than exercise price. So call option holder make loss if he exercise his call option contract. If you look at this call option, now the investor or call option holder has 2 alternatives, whether he want to buy share at a market price, which is he just need to pay 1,400, or he can buy share by using his call option where he needs to pay 1,600. That's why this call option is considered as a out of the money, because if the call option holder exercise the contract, the call option holder make loss in the market because he needs to buy at higher price. Okay, now next we look at what happened if the market price of share is at 1,600. If the market price of share is at 1,600, the call option with exercise price 1,600 is considered at the money condition or situation. Why? Because the market price is equal to exercise price. So in this case, 1,600 is the market price. The exercise price is also at 1,600. So in this case, call option holder get no profit or loss if he exercise his call option contract. Okay, so next, how about if the market price of share is moved to 1,900? So if the market price of share is moved to 1,900, the call option with exercise price 1,600 is considered is in the money contract. In the money contract means the call option holder get profit if he exercise his call option contract. That means the call option holder can buy share at lower price compared to the market price. So in this example, let's say the investor exercise his call option contract, he only needs to pay 1,600 in order to buy the share. Compared if he buys straight away from the market, he needs to pay 1,900. Okay, so out of the money for call option, market price less than exercise price. That means you make loss when you exercise the contract. Call option at the money is a condition where market price equal to exercise price. That means the call option holder get no profit or loss, and the call option in the money when market price is higher than exercise price, where the call option holder make profit if he exercise his call option contract. Okay, now we look at example for put option. Okay, so let's say we have one put option. The contract is OKLI September 1900 put at 21. Okay, so that means this option contract is going to expire in September. The exercise price is 1900. The contract is a put option contract with the premium or the price of put option contract is 21. Okay, so we have three market price of share in this example. The first one, let's say we assume today the market price of share is at 1,800. So 1,800 for put option with exercise price 1,900 is considered as a in the money contract. Why in the money? Because market price is less than exercise price. So that's mean the put option holder get profit if he exercise his put option contract. Okay, instead of selling the share at market price 1,800, in this case, the investor can sell the share at higher price by using his put option contract, where he can sell his share at price 1,900. So he make profit when he exercise his put option contract. So that is in the money contract. Okay, what happened if the market price is at 1,900? So if the market price move to 1,900, the put option with exercise price 1,900 is considered as a at the money contract. At the money means market price equal to exercise price. So in this example, 1,900. That means the put option holder get no profit or loss if he exercise his put option contract. Okay. Now we look what happened if the market price of share move to 2,000. So if the market price of share move to 2,000, the put option contract with exercise price 1,900 is out of the money contract because market price is higher than exercise price. So the market price is 2,000, exercise price is just 1,900. So if you as a put option holder exercise the contract at this time, that means you make loss because you sell at lower price compared to the market price of share. So if the contract is in out of the money contract, usually put option holder will let the contract expire. So he will not exercise the contract. Now we move to the factors affecting the option premium, or sometimes we call it as a option price. The first factor is the price of the underlying asset or the market price of share. If the price of the underlying asset moves up and down, the option price or the option premium is affected. In the case of call option, if the price of the underlying asset increase, so the call option become deeper in the money. That means the call option is become more profitable the higher the premium of the option because the demand for the option is higher. Okay, so when the option make profit, then the demand for the option will increase and it will result increase in the premium of the option. On the other hand, for the put option, as the price of underlying increase, the put option will have a lower premium because the demand of the option is decreased, okay, and vice versa. Okay, we look at this example, how the changes of market price of share will affect the premium of the call option. Okay, so we have OKLI September 1,600 call at 18. Okay, let's say current market price of share is at 1,600. So that means the call option is at the money. So at the money means the call option is not making any profit. Okay, now the call option, the market price of share, let's say first we focus on market price of share decrease. Let's say the market price of share is dropped to 1,400. That means the call option is out the money. So out of the money means if you have this contract, you will get a loss. So because of market price of share decrease, call option out of the money means it make loss. So when the contract make loss, less demand for the call option. The investor will not buy a contract with a probability to make a loss. So when the demand decrease, the price of call option also decrease. Okay. So if the market price of share decrease, call option premium decrease because less demand for the call option. Why less demand for call option? Because the call option make loss. So investor would not buy a call option where they know that the call option will make loss. Okay. Let's say the market price of share increased to 1,900. If the market price of share increased to 1,900, the call option is in the money. In the money means a call option make profit. Okay, so market price of share increase, call option in the money. In the money means make profit. So investor will buy a call option. So that means more demand for the call option in the market. When demand increase, call option premium or call option price also increase. Okay. So if you look at this example, we can see that for call option, the exercise price has positive relationship with the the call option premium has positive relationship with the market price of share. So if the market price of share decrease, call option premium decrease. If the market price of share increase, call option premium increase. Next, we look at the example for put option. Put option, OKLI September 1,900 put at 21. So let's say current market price of share at 1,900. That means the put option is at the money. If the market price of share decrease, let's say the market price of share decrease to 1,800. That means the put option is in the money. In the money means more make profit. When the put option make profit, demand for put option increase, and as a result, put option premium also increase. What happened to the put option if the market price of share increase? When the market price of share increase, let's say in this example, increase to 2,000, the put option become out of the money. So out of the money option means the option make loss. When put option make loss, investor would not buy this put option. As a result, less demand for the put option, and it will cause the put option premium decrease. So from this example, we can see that put option premium has negative relationship with market price of share. Okay, so when market price of share decrease, put option premium increase. When market price of share increase, put option premium decrease. Next, the second factors that affect the option premium is strike price. So for call option, a call option with higher strike price will have a lower option price compared to call option with lower strike price. This is because the call option with higher strike price has lower intrinsic value. So you can see from these two examples, okay, the first box, the exercise price is 12. The second call option, the exercise price is 10. So if you calculate the intrinsic value for call option with exercise price 12, it's only 0.4. But intrinsic value for call option with exercise price 10, the intrinsic value is 2.4. So when you could calculate the call option premium, exercise price is high, call option premium is low at 0.58. If the exercise price is low at 10, then the call option premium is high at 2.58. Alright, for the strike price for put option, a put option with higher strike price will have a higher option price compared to a put option with a lower strike price. This is because the put option with higher strike price has higher intrinsic value. So if you look at this example, we have two put option. The first put option, the exercise price is 15. The second put option, the exercise price is 20. So put option with lower exercise price will have a lower intrinsic value. So if you look at this example, the intrinsic value for lower exercise price of put option is at 2.6. So when you calculate the put option premium, the price is at 2.78. For put option with higher exercise price, the intrinsic value is 7.6. So when you calculate the put option premium, the price becomes 7.78. Okay. The next factor is expiration time. Whether it is a call option or put option, both will have higher premium if their time to expiration is longer. This is because these options have more times to gain in their intrinsic value as compared to those options with short time duration. An option is said to be a wasting or depleting asset as the time to expiry approaches. Okay. The next factor is interest rate. The premium of the option is also influenced by interest rate. Higher interest rate result in borrowing money to buy underlying asset to become expensive and vice versa. As such, option become cheaper in rising interest rate and expensive in falling interest rate. Therefore, the level of interest rate and the price of option have an inverse or negative relationship. The next factor is market volatility. The higher the volatility of the underlying asset, the higher is the chance for the underlying asset to fluctuate in both directions. This will enhance the investor opportunity to make large gain or profit. Both call and put option premium increase when the volatility of the underlying asset increase, and likewise if the volatility decrease. As such, the more volatile is the market, the more will be the current price to change, and hence more attractive will be the options for investment purposes. The last factor is dividends. Usually, dividends have an impact on stock option. After dividends are paid, the stock price will decline for adjustment purposes. For a call option, the decline in stock price will result in the option become less valuable, and hence the option price is lower, and vice versa for the put option. Therefore, put option become more valuable, and this leads to the higher option price. That's all for the introduction of option contract. Thank you.